Welcome to our Intermediate Trading Concepts series. Today, we're exploring a critical but often overlooked aspect of trading: trading psychology. Understanding the psychological elements of trading is essential for consistent success in the financial markets. Trading psychology refers to the emotional and mental state of traders, which can significantly impact decision-making. The highs and lows of trading can evoke strong emotional responses, influencing trading behavior. Emotional biases like fear, greed, and overconfidence can lead to irrational decisions. Fear can result in selling too early or not entering profitable trades, while greed may lead to holding positions too long or overtrading. Overconfidence can cause traders to underestimate risks and overestimate their ability to predict market movements. For example, during market downturns, fear can drive traders to sell at a loss, while in bull markets, greed might prompt them to ignore signs of a looming correction. A well-defined trading plan is crucial for combating emotional biases. It should outline your investment strategy, risk tolerance, entry and exit criteria, and methods for risk management. Sticking to this plan helps maintain discipline and objectivity. Disciplined traders often review and adjust their plans regularly, but avoid making impulsive changes based on short-term market movements. Effective stress management and maintaining a healthy mindset are key components of trading psychology. Techniques like meditation, regular exercise, and ensuring work-life balance can significantly improve decision-making and emotional resilience. For instance, many successful traders allocate time for daily meditation to enhance their mental clarity and emotional stability. Learning from losses and mistakes is another vital aspect of trading psychology. Viewing these as opportunities for learning and growth, rather than failures, helps build experience and improve future strategies. Experienced traders often conduct post-trade analyses to understand what went wrong and adjust their strategies accordingly. In conclusion, mastering trading psychology is as important as mastering market analysis and trading strategies. A balanced emotional state, disciplined adherence to a trading plan, and continuous learning from experiences are fundamental for long-term trading success. Thank you for watching. Stay tuned for more insightful topics in our Advanced Trading Concepts series, where we'll delve deeper into advanced strategies and market trends. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.